Welcome to the 2012 Federal Budget. I'm glad you're able to join me this morning to look through in detail some of the changes and importantly the impacts and strategies surrounding those changes. It's been quite a tiring day, well, a couple of days for me, looking through the changes and putting together a paper which hopefully you would have received and read it in the last day. The process would be if you had read it and this morning to go through some of the facts and the details of the changes, and then for me to put to you some of the strategies, if you like, that might apply to your clients. Okay, so that's the way we would do it, and if I could just take you through a quick outline of the various parts and areas that we'll be looking at. It is one of those budgets where, it's not that exciting a budget, but at the same time it covers a range of issues, and this morning we will cover through, in the next 45-50 minutes, a range of issues and covering from sort of taxation to company tax, CGT, and finishing off with some of the changes in the Social Security and aged care arena. So let's start by looking at, for a start, some of the changes in the tax area. And the first part and the first change that I'd like to take you through is looking at ETPs, Employment Termination Payment, and specifically about ETPs tax offset. And these changes are coming through from 1st of July, so in the next month or so, at the end of the month. The change is required, according to the government, that ETPs have been paid to executives when perhaps the concessions should be provided, and should only be provided under genuine cases such as redundancies. So the existing provisions allow ETPs to be paid concessionally, regardless of the situation under which the payment is made. So to tighten up this particular concession, then from 1st of July 2012, what the government is proposing to do is that the ETP offsets is only going to be available on payments which are within $180,000, what we call the whole of income cap. That means that the ETPs, when added together with other taxable income, so long as it's within $180,000, would be taxed at the normal concessional rate. If it's over the whole of income cap of $180,000, then any excess amount of the ETP would simply be taxed at the marginal tax rate. We also mustn't forget that the ETP cap, the usual ETP cap of $175,000 for 2012-13 still remains, and for example, if someone aged over 55, above the preservation age, subject to the cap of $175,000 is 15% tax plus Medicare levy. Anything beyond that rate, that threshold, then the top tax rate would still apply then. So there are two rules here that we need to understand if your executive client is going to receive an ETP payment. Firstly, the $180,000 and overlaid by the normal ETP cap of $175,000. Remember the case that with genuine payments, such as redundancies, then the normal rules still exist, so we don't have to worry about $180,000 whole of income cap if the payment is as a result of redundancies, for example. Now, what are the impacts then for your clients? Well, if your executive client is going to receive a payment which doesn't come under a genuine payments, for example, then that means that we should consider making the payments before the year end. Another possibility is to perhaps restructure the payment in some other ways that will not be part of the ETP payment. The next area that I'd like to take you through is really some changes to the net medical expenses tax offset. The change here is again from 1st of July 2012. There will be a means test that will apply to the tax offset, the medical expense tax offset, which in the last few years, or pretty much when it ever existed, is really based on the level of medical expenses rather than being means tested. So from 1st of July, this is the main change here for your clients where they may have medical expenses during the year. So the current situation is that if your clients, so this is net medical expenses, net of any rebates. So if you have medical expenses which are partly paid by private Medicare, then that will be excluded, but what is out of pocket is what I'm trying to say here. Then at the current time is anything above $2,000, there will be a rebate of 20% in excess of that. But from 1st of July 2012, it really depends on how much your client is earning before we could look at the thresholds that we need to apply. So from 1st of July 2012, for your clients where the adjusted taxable income, so that's ATI, above the Medicare levy surcharge, which applies $84,000 if you've got a single client, or $168,000 for a family client. And based on those Medicare levy surcharge, if one is above that, then the new thresholds would apply. So it only applies for if in total your net medical expenses is above $5,000 instead of $2,000, and the rebate is only available at the rate of 10% instead of 20%. So therefore, only clients above $84,000 for single or $168,000 as a family, that this would apply. For clients that are under the thresholds, then the normal rules would still apply, so nothing changed there. So in terms of considerations for your clients, perhaps if your client's going to fall above those thresholds, then your clients should perhaps consider bringing forward some of the medical expenses. If someone needs to go to the dentist or have an operations perhaps, then do it before the 30th of June. That's what I would suggest. The other thing is obviously accumulate as much as possible all medical expenses into 1 year. So again, if we can't make it this year, then make sure you have all the operations that you need in the next year, right? And bring forward to the next year too. So it's all about trying to get above that $5,000 limit for those who are above the Medicare levy surcharge thresholds. And don't forget, we need to capture all medical costs, so that includes the prescriptions too. I've come across too many times where we tend to forget our clients, not remembering or not having the receipts to exactly know what the costs are. It's just making sure that we capture all the costs and making sure that we can all add up to that as much as possible above that $5,000 limit if that rule applies. Okay, now let's have a look at what I call tax scraps. So these are the ones where we have this current government, a lot of promises, but not seeing them through. Now, the first three of them, which you'll be quite well aware of, which have been promised to us in the last year, 2 years. Some of them we may have sort of forgotten, but they have been sort of worked on, but the government at the current time in the budget said, look, they are not going to go through with it. And the first one is that 50% tax discount for interest income. If you recall, there was meant to be 50% tax-free amount on bank interest income, and that is no longer available. So we have to look at other alternatives if we can. The other known to a promise, again in the last year or two, is the initial promise that we would have a standard deduction for work-related and managing tax affairs expenses. That was meant to make it easy for all of us to prepare the returns and have a fixed amount as a tax deduction. Again, that's certainly no longer available, scrapped. Company tax cuts. That was promised to us at 29%. That is no longer available as well too. So three very important promises that we no longer see, and it's been scrapped. A couple of other ones, phasing out matured age workers tax offset. That's for your information if you have clients falling into that category. And again, from 1st of July 2012 in the new financial year, and that phase out for those who were born on or after 1st of July 1957. Now, the last change in terms of no CGT discounts for non-residents, again, it applies to your clients who are non-residents for Australian tax purposes, and that applies from budget night, from